I'm Warren Pierson, Deputy Chief Investment Officer with the Baird Funds, and today joining me are Meg Dean and Pat Brown, both Senior Portfolio Managers with our group, and they're also co-leads on the structured securities, which would be mortgages, asset backs, and CMBS. 2020 has been a very unusual year, a very challenging year, and especially some of the structured securities and markets have really struggled. We've navigated this sector really well. We've fared really well. Can you give us talk a little bit about the guiding principles that have helped us navigate this treacherous market so well?
It begins with really our positioning, and we purchased AAA rated, non-agency, agency, MBS, ABS, and CMBS securities, starting at the most senior portion of the capital structure. We look at the quality of the underlying of the collateral, the strength of sponsor, servicing, as well as the market participants. How deep is this sector? What sort of liquidity? We talk about when we structure the Baird Bond Funds, how important layers of liquidity are to the portfolio, and specifically the role of the structured products portfolio within the portfolio in providing those essential layers of liquidity. So we've seen very strong performance out of our asset-backed positioning. Also, within the CMBS section of the portfolio, we express that entirely in conduit structures. And conduit is really broadly diversified CMBS securitizations where you have anywhere from 50 to 70 loans on average, fixed rate, index eligible, and also TELF eligible. So it really enjoys that enhanced layer of liquidity from those. We avoid sectors such as student loans, particularly the federal programs. While it's guaranteed, 97% principal guaranteed, those liabilities of those structures are LIBOR-based. And we remain concerned about the end of LIBOR, that expected cessation at 2021. That also transfers over into CMBS, where we avoid single asset, single borrowers, also known as SASB deals, where you have a focus on single loans, primarily hotels and office has been really the two largest subsectors within that space. Since the onset of the pandemic, hotels have been really the weakest performer, followed closely by retail.
So it's been a preference for senior structures,
Correct.
But also very particular about the types of collateral
That's
that we've
correct.
owned. Well, interest rates have fallen this year as well. They've also been pretty volatile. Talk about some of the things that we've done to protect our portfolios from that interest rate volatility.
Yeah, Warren, you're right. Interest rate volatility has definitely been with us this year. And one of the long-term biases or tilts that we like to put on our portfolios that help protect the portfolios from heightened periods of interest rate volatility is to have a convexity advantage or positive convexity tilt on the portfolio. What I mean by that is simply that we want the duration of our portfolio to be more stable than that of the benchmark when you see periods of interest rate volatility like you described. We do this in a couple of ways. The major way is that we focus on sectors, like Meg just described, that are less adversely impacted from those large changes in interest rates. Think the well-structured CMBS or asset-backed securities that Meg just talked about. The one sector of the market that's really impacted by that interest rate volatility is the agency mortgage sector. And one efficient way for us to achieve this duration stability that I'm talking about is to underweight that sector in the market. And 2020 has been a great living laboratory for how that actually works in practice. As you said, interest rate volatility has driven the U.S. 10-year Treasury over 125 basis points lower this year, which has also driven U.S. mortgage rates to record lows, which is great for the U.S. consumer, U.S. borrower, as Meg talked about, because they get to refinance those mortgages at those lower rates. However, that is not a good thing for agency mortgage investors. And that's evidenced by, if you look at the Bloomberg Barclays Mortgage Index, the duration of that index has dropped over a year as mortgage rates have dropped. And the last thing you want to happen as an investor when rates are dropping is to have your duration shorten on you. So by having that underweight to that sector, our portfolios have been able to maintain their duration better, and that's helped the portfolios outperform.
Apart from just the gross underweight to the sector, are there other things that we do, the types of securities that we buy or
Yeah, that's
stay
a good
away
point.
from?
Within our agency mortgage strategy, we use our individual bottom-up security selection to seek out those bonds that are backed by mortgages from borrowers that are less reactive to those changes in interest rates. For example, that might be mortgages that are backed by seasoned borrowers, so a borrower that took out their mortgage 5 to 10 years ago that have had ample opportunity to refinance that mortgage already, or backed by mortgages that have lower average loan sizes, where that individual borrower needs a greater incentive to refinance to offset the fixed cost of refinancing. The last thing I'll mention about this duration stability tilt that we have in the portfolio is how it fits into the overall portfolio structure. If you think about periods of interest rate volatility like you alluded to this year, it often comes at times when there's an economic shock in the backdrop. And if, for example, we might be modestly overweight corporate bonds, let's say, when that economic shock hits, this positive convexity tilt that we have in the portfolio can help offset some of the potential short-term underperformance from that corporate bond overweight.
The Fed has been very involved, supporting, if not controlling, much of the mortgage market. There's good signs that the housing market is pretty healthy, but there's still some concerns in the commercial real estate market. How do you pull all this together in terms of our outlook for the sector, but also, what are we doing in the portfolio moving forward?
The Fed's response to the pandemic has been unprecedented in terms of its size and its scope. As they've restarted their quantitative easing program, the balance sheet has gone from $4 trillion to over $7 trillion in just a short 6-month time period. And a lot of people think it's heading on its way to $10 trillion in total assets. In our sectors that we follow, the most directly impacted sector is the agency mortgage sector, where the Fed has purchased over $600 billion in assets. Prior to the Fed's entry into the space, we were active adding exposure at much more attractive valuations than agency mortgages. But since the Fed has increased their activity in the sector, valuations have tightened. And we also remain concerned about where mortgage rates might head. In fact, head potentially even lower, even though they're already at record low rates. The reason for this is because if you look at mortgage rates relative to something like U.S. Treasuries, they're still relatively high, meaning that there's room for them to move lower, giving those underlying borrowers even more incentive to refinance their mortgages. So we've continued to focus our activity away from that sector now and in other segments of the market where we see better relative value, but still enjoy the Fed backstop and liquidity.
So while those prepayments have ramped up, there could be more to come. And the TBAs, or the to-be-announced pools, is that where you see probably the biggest variability or the most responsiveness into those refinancing?
Yes, those generic mortgages in the market, the large pools that are backed by the most sophisticated borrowers that have higher credit scores, higher average loan sizes, those are the borrowers that will react very quickly to a small incentive, to a positive incentive to refinance. So we tend to avoid those types of collateral.
Meg, what about the commercial side? I know we've protected ourselves very well. Should we be worried about the structures we owned? Or, you said before there likely will be some losses in that market. Where will we find those?
We've seen very strong performance out of the multifamily sector. We do express our overweight multifamily sector through agency CMBS. And new to quantitative easing, this March, the Fed expanded its mortgage purchase program to include agency CMBS, which actually for the first half of 2020 was the strongest performing sector behind treasuries. So we like our overweight in agency CMBS, entirely comprised of multifamilies. Now, in more traditional CMBS, commercial mortgages, we do have some concern, namely about hotels, but within hotels, the luxury hotel segment. We are seeing actually decent performance out of economy hotels or economy lodging. Retail, that was a well-known, advertised concern prior to the pandemic. Clearly, we've seen weakness there. But certainly even within retail, luxury retailers are suffering more so than Walmart's, for example, or Target's. So we are seeing different segments within these sectors and different performance trends. And really we talk about, when we look at risk, it's the risk lifting up the hood and what sort of diving into those level 2, level 3 layers. How well are these loans underwritten? Where's the location of the property? The seller and the sponsor of the property will be ultimately determine how they perform. So we like the conduit structure, we like the diversification, and we like that index eligibility that really deepens the liquidity.
What about even office towers? I mean,
Right.
There was some prime office space that everybody thought was rock solid. There were some of the single asset, single borrower deals or the
Yes.
SASB deals that you guys talked about. Any of those structures in trouble?
There are some concerns certainly within the office sector, and office actually, to your point, dominated the single asset, single borrower space. Behind office, it was really actually luxury hotels. So there is some concern in that space, and certainly the flight out of urban centers. That actually has been supportive of housing, but does raise concerns about Class A office, for example. What we do find somewhat encouraging in Class A office, particularly, is that the companies that lease enter long-term leases. So you're looking at 10-year leases, where, for example, in hotels, you're turning over every night. So the behavior of that underlying tenant, so to speak, is very different. But we do remain cautious, and certainly the scope and the landscape for working from home has changed dramatically in the past 6 months. And another reason why we like the diversification.
But staying up in quality, senior in the structure,
Correct.
and then being very particular about the collateral has served us well.
Correct.
Well, it's been a really interesting environment this year. And, sometimes when you've been doing this for decades, you think you've seen everything, but clearly that's not the case. We've seen things this year that we've never seen before. And again, thanks for all your efforts, because you guys have done a great job in helping us navigate this very treacherous environment very successful. So thanks for joining me today.
Thank you, Warren.
Thanks, Warren.
Thanks.
Appreciate it.